Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So the markets are a bit choppy these days. We've got the S&P and the Dow doing okay. They're up and down, but they're sort of holding their own. We do have the Nasdaq having a little bit of trouble here as interest rates start to go up. That tends to weigh on smaller businesses, which is typically what's in the Nasdaq. And so there's some selling off over some concerns about the impact of interest rates on smaller companies. The media is referring to it as a tech sell-off, but I think that's really overblown. I mean, the tech sell-off was during the dot-com bubble, and when that exploded, that was a tech sell-off. This is just normal volatility, and it's really not based on a whole lot, because in the grand scheme of things, when you look at where interest rates are, they're still really close to historic lows, relatively speaking. So we don't see that as any sort of a major issue with the markets going forward. Volatility is what volatility is, and speculation is what speculation is. So we have to anticipate that the markets are going to be going up and down, sort of in a strange fashion, but not be too worried about it as long as the underlying fundamentals of the markets and the economy remain sound, and they do. But that's not what I wanted to talk about today. Today, what I want to talk about is, rising interest rates and our national debt. Now, Congress just passed a $1.9 trillion COVID relief bill. Some argue that it's not really COVID relief, but that's not my job to argue that point right now. All of that money is going to have to be financed because it's all borrowed money. It's not like our government's running a surplus. The U.S. government spends more than it brings in, and has through my entire lifetime, with one small exception during the Clinton administration. So as this $1.9 trillion gets borrowed, if interest rates are going up, that means that the cost of that borrowing goes up too. Not to mention, as interest rates rise, or should interest rates continue to rise, as we refinance debt that we maybe took out 10 years ago or 20 years ago, that it might cost us more than we anticipated to refinance that debt. So rising interest rates, can be a problem, especially when it comes to the national debt. In addition to the $1.9 trillion, the Biden administration is sort of floating the concept of what they're calling an infrastructure bill, and the spending on that is anticipated to be somewhere between $2 trillion and $4 trillion. These numbers are mind-boggling. But again, as long as interest rates remain low, all this borrowing doesn't have a sort of an immediate impact on the financial solvency of the U.S. government or the U.S. economy. There still is plenty of liquidity in the financial market to absorb this kind of debt. Our biggest concern is that if interest rates rise into the more historic average, which would be 2 to 3.5% higher than where it is right now, then as we start to refinance debt that we took out at much lower interest rates, that's when the government is going to start having some troubles, because then the interest that we have to pay on that debt is going to start to consume a larger and larger percentage of total federal expenditures, and that's when really hard choices need to be made. Do we add more taxes? Do we cut spending? These are things that nobody's really thinking about right now, other than there are some new proposals to increase taxes on certain individuals and businesses. But in general, the government's just saying, we can borrow the money and we can spend the money, and they're going to do that. So we're watching this situation pretty closely, because at the rate that we're adding new debt to our national debt, these problems become more real and more imminent. Not saying that they're pressing us right now, but they do become things that we can look out into the future 5 and 10 years and go, gee, what is the U.S. budget going to look like when we have $35 trillion in debt and the annual interest payment is $1 trillion? Now, we're not near any of those numbers right now, but we're heading in that direction. So this is something we're watching pretty closely. It's not of immediate concern. And I know as the media, talks about like rising interest rates, they talk about how crippling that could be to our economy. Interest rates are still so ridiculously low that anybody who's saying that they can't do something because interest rates are too high, they probably shouldn't be doing it in the first place. But it is something that we're watching pretty closely, and we think you should too. But again, to sort of counter the media narrative of rising interest rates is going to cripple our economy, or the current government spending is going to wipe out the U.S. dollar. These are things that we need to be concerned about, but they're not things that we need to worry about right this minute. They will have an impact in the future if we don't change our ways, but it's not something that you want to necessarily be selling out of the market today in anticipation of a potential financial issue 5 or 10 years in the future. There's an old saying, make hay while the sun is shining. Right now, as the government continues to open more things up, we're going to see economic expansion. We're going to see GDP continue to grow. We're going to see the unemployment rate fall. These are all positive economic indicators. And so we want to make hay while the sun is shining. And, the sun is, if not shining, it's certainly peeking out of the clouds right now. And so we don't want to be, sort of short-sighted or overly alarmist and bail out of the markets sooner than we might otherwise have to. So if anybody has any questions about this or any other financial matter, please feel free to give me a call, send me an email, make a comment to this post. I'll answer any question you might have. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.